Right now, as you're watching this video, a silent gold rush is underway. Billions of dollars are pouring into a layer of the economy most retail investors have never even heard of. And 4 specific stocks, sitting right at the center of that storm, could either make early investors generational wealth or become the most expensive mistake they've ever made. Welcome to Smart Stock Sam. And today, we are going deep, dangerously deep, into Applied Digital, CoreWeave, IREN, and Nebius Group. By the time this video ends, you'll know exactly which of these companies is the strongest, which ones carry hidden landmines, and most importantly, where the smart money is actually moving right now. Stay till the end, because we have a hidden metric that most analysts aren't even talking about. And once you see it, it will completely change how you think about these stocks. Before we get into the names themselves, let me paint you a picture of the world these companies are operating in. Because there's a massive contradiction happening right now that Wall Street keeps glossing over. On one hand, we are witnessing triple-digit revenue expansion across the board. These companies are not small players experimenting with ideas. They are making the full transition from old, sluggish legacy data centers into GPU-accelerated cloud services. They are locking in the kind of revenue you dream about, long-term leases with hyperscalers, the Microsofts and Metas of the world, creating something that looks almost like utility-level income predictability. That is the bullish side. The revenue charts look like rockets. But here is where it gets dangerous. To fuel this kind of growth, every single one of these companies is loading up on debt. We're talking capital expenditure growth of over 150,000% in certain cases. Read that again, 150,000%. The machines they need, primarily NVIDIA chips, are not cheap. The power infrastructure to run those machines is not cheap, and the facilities to house them are absolutely not cheap. So even as revenues are rocketing upward, earnings per share are being crushed under the weight of the debt needed to finance the build-out. What we are watching in real time is a race, cash flow stability versus speculative excess. And depending on how that race ends, you either get the next great infrastructure giant or one of the most spectacular collapses in tech stock history. Now let's figure out where each of these 4 companies actually sits. Think of the entire artificial intelligence market like a skyscraper. Each floor has a different company, a different risk profile, and a different reward potential. At the very top of the building, you have the software and machine learning layer. This is where Nebius Group, ticker NBIS, lives and operates. Below that sits the hardware and GPU cloud layer, the pure, raw, concentrated compute power. And that floor belongs almost entirely to CoreWeave, ticker CRWV. Support all of that, and you need the campus and leasing layer, the physical shells, where this technology actually lives. That's where Applied Digital, ticker APLD, is building their empire. And at the very foundation of the skyscraper, holding up every single floor above it, you have the energy and facilities layer. That is where IREN is making its most aggressive pivot. 4 floors, 4 companies, 4 completely different stories. Let's go floor by floor, starting with the one that has a backlog so big it sounds like fiction. Applied Digital, the landlord, the builder, the company sitting on a contracted backlog of $23 billion. Let that number settle. $23 billion in committed contracted future revenue. Their year-over-year revenue growth just came in at 139.3%. bringing total revenue to over $108 million. And the crown jewel of their portfolio right now is a 15-year, $7.5 billion lease for 300 megawatts of capacity at their Delta Forge 1 campus. Think about what a 15-year lease means. That means a hyperscaler, one of the biggest technology companies in the world, has committed to paying Applied Digital for the next 15 years. That is not speculative revenue. That is contracted, locked in, almost immovable revenue. Applied Digital is also executing a transition that is absolutely critical to their long-term story. They are moving away from the erratic, cyclical, mood swing-driven world of crypto mining revenue and planting their flag firmly in the predictable, recurring world of hyperscaler leases. That is a fundamentally better business. But here is where I need to slow you down and make sure you are seeing the full picture. Because while that backlog creates an enormous valuation floor, and it genuinely does, a backlog is only worth something if the company can actually build what it promised. And that is where we need to look at the technical and financial reality. The net margin for Applied Digital right now is negative 52.84%. They missed earnings per share estimates by a wide margin, coming in at negative 36 cents versus an estimate of negative 13 cents. Their price-to-sales ratio sits at 30.2 times, compared to the US IT sector average of just 1.8 times. 30 times revenue for a company with negative margins. That is a bet on execution, not current fundamentals. The chart is also flashing a warning signal called a death cross, where the 50-day moving average at $28.27 has dropped below the 200-day moving average at $29.93. That is a technical pattern that often precedes extended price weakness. And here is the number that should truly give you pause. Applied Digital carries a beta of 7.25. That means this stock moves 7 times more violently than the broader S&P 500. On a bad day in the market, this stock can absolutely punish you. Now, the institutional picture is genuinely interesting. Vanguard, one of the most conservative, slow-moving, data-driven institutions on the planet, increased its stake in Applied Digital by 36.4%, adding 24 million shares. That is serious conviction from serious money. But at the same time, Director Chuck Hastings sold $1.77 million worth of shares, reducing his stake by 10.59%. You have one of the world's largest institutions buying aggressively while an internal director is selling. Which side of that trade do you want to be on? That tension tells you everything about where we are in the Applied Digital story. Now let's move up the stack to the company that is arguably the most exciting and the most terrifying of the four. CoreWeave. If Applied Digital is the landlord, CoreWeave is the brain surgeon. They don't try to do everything. They don't offer generic cloud services to small businesses. CoreWeave focuses exclusively, obsessively on one thing: large-scale model training and compute-intensive inference. That is it. While Amazon Web Services and Microsoft Azure and Google Cloud are all trying to be everything to everyone, CoreWeave goes deep, specialized, uncompromising. And in the current environment, where AI chip supply is being hoarded and GPU compute is more valuable than oil, that specialization is printing money. Their fourth quarter revenue hit $1.57 billion, a 110.4% increase year over year. Analysts at Citizens JMP have a price target of $180. D.A. Davidson sits at $175. They are the primary beneficiary of the global artificial intelligence chip shortage, largely because they had the foresight, or perhaps the luck, or perhaps both, to secure NVIDIA chip supply early and at massive scale. When the whole world is begging for compute, CoreWeave already has the compute. That is an almost unfair competitive advantage. But does that advantage hold when you look under the hood? Here is where CoreWeave's story gets complicated. And I want you to pay close attention, because this hidden data point changes the entire risk calculus. CoreWeave carries a debt-to-equity ratio of 4.46. For context, anything above 2 is typically considered highly leveraged. 4.46 is aggressive, but the number that truly sets off alarm bells is the current ratio of 0.46. A current ratio below 1 means a company has less liquid assets than it has short-term obligations coming due. 0.46 means CoreWeave has less than half the cash it needs to cover its near-term liabilities. Weiss Ratings, a firm known for not sugarcoating anything, has rated CoreWeave a hard sell based on this financial profile. Their return on equity sits at negative 33.82%. But here is the number that dominates the entire CoreWeave conversation and should dominate yours. Over the last 90 days, we have seen $1.63 billion in insider selling. $1.63 billion. Brian Venturo alone sold $9.4 million worth of stock. Westclay Capital LLC reduced its position by $582.85 million. Now, insider selling happens for many reasons: diversification, taxes, estate planning. But when founders and early investors are liquidating at that scale, the signal is hard to ignore. It suggests that the people with the best information about this company believe we may be near a mid-term valuation ceiling. I'm not telling you to sell or not to buy. I am telling you to factor that into your thinking. Now let's move down to the foundation of our skyscraper, IREN. This is the most dramatic pivot story in the entire group, and possibly one of the most dramatic pivots happening in the market right now. IREN is trying to completely shed its identity as a Bitcoin mining company and re-emerge as a high-speed artificial intelligence cloud company. Analysts at Bernstein are actually extremely bullish on this story. They are maintaining an outperform rating with a price target of $100. They explicitly describe this transformation as capital efficiency re-engineering. Even when they cut their target from $125 down to $100, they were crystal clear. The cut was driven purely by share dilution and reduced Bitcoin mining revenue, not by any change in their view of the artificial intelligence cloud fundamentals. Their clean energy footprint, they argue, gives IREN a structural advantage in the AI race. Hyperscalers and large technology companies are under enormous pressure to power their AI infrastructure sustainably. A company that can offer clean energy and high-speed cloud infrastructure at scale? That is an incredibly compelling pitch. But here is the question every IREN investor needs to be able to answer honestly. Has IREN actually decoupled from Bitcoin yet? Because the technical data says no. When you overlay IREN's equity price against Bitcoin's price chart, the correlation is still uncomfortably tight. The stock is still mathematically tethered to what Bitcoin does. And that means IREN is still, in the market's eyes, at least partially a crypto play masquerading as an artificial intelligence play. The MACD is showing a bearish crossover. Momentum is slowing with an RSI of 56.5, and the options market is pricing IREN with an implied volatility of 131.31% compared to a historic volatility of 84.74%. The market is massively overpricing near-term risk in IREN's options. That near-term risk is being severely overpriced. Until IREN can demonstrate, through consistent price action, that it can hold its value when Bitcoin drops, it remains a hybrid position, not a pure artificial intelligence bet. And now we reach the top of our skyscraper, Nebius Group, ticker NBIS. And I want to argue that Nebius is playing a completely different game from everyone else on this list, and that difference might be the most important thing in this entire video. While Applied Digital builds physical shells, CoreWeave rents out raw GPU power, and IREN provides energy infrastructure, Nebius is doing something that none of the others can easily replicate. Through their Toloka AI platform, Nebius handles the entire Gen AI lifecycle: data annotation, model training, quality assessment, all in one ecosystem. This means they are not just a vendor you plug into. They become an indispensable partner for every enterprise that wants to build and deploy artificial intelligence. They are not selling you a shovel. They are the complete mining operation. That software layer moat is genuinely difficult to commoditize, and in a sector where hardware is becoming increasingly fungible, differentiation through software is where the durable value lives. The fourth quarter revenue came in at $227.7 million. And while they did miss their EPS estimate, coming in at -69 against an estimate of -42, the directional momentum is clear. Analyst price targets range from Morgan Stanley at $126 all the way to D.A. Davidson and BWS Financial at $200. And crucially, Nebius carries a quick ratio of 6.57, the strongest liquidity position in the entire group by a wide margin. While CoreWeave is struggling to cover its short-term liabilities, Nebius has more than 6 times the liquid assets needed to cover its obligations. That is financial resilience in a sector that demands it. But Nebius, like the others, has its own tug-of-war playing out. On the institutional side, Zürcher Cantonal Bank, a Swiss cantonal bank and one of the most sophisticated institutional investors in Europe, increased its stake in Nebius by 34,371%. That is not a typo. The Texas Teachers Retirement System opened a fresh $8.84 million initial position. This is endowment money. Slow, careful, long-term, diversification-focused institutional capital. It does not chase momentum. It buys conviction. At the same time, we have seen $14.67 million in insider sales over the last 90 days. Now here is where you must pay very close attention, and this is the critical distinction that separates a panic signal from a non-event. These sales by CEO Arkady Volage and CTO Danila Stan were executed strictly under Rule 10b-51 plans. That means they were programmatic, pre-scheduled, set up in advance. These are not executives waking up one morning, looking at the stock price, and deciding to bail. These are structured, pre-planned liquidations. For a long-term investor, that distinction is everything. Now let's step back and put all 4 of these companies side by side, because the comparative picture is what actually drives your decision. APLD has that breathtaking $23 billion contracted backlog and investment-grade tenants, but is weighed down by a negative 52.84% margin and a 30.2 times price-to-sales ratio. CoreWeave dominates GPU cloud with $1.57 billion in quarterly revenue and the best technology positioning in the group, but a current ratio of 0.46 and a debt-to-equity of 4.46 make it a liquidity time bomb. IREN has the clean energy moat and Bernstein's conviction, but share dilution and its stubborn refusal to technically decouple from Bitcoin keep it in a hybrid no man's land. And NBIS offers the best liquidity, the most defensible software moat, and the strongest institutional accumulation, but came off a revenue miss and carries a negative return on equity. Every single one of these companies has a compelling bull case, and every single one of them has a flaw that could absolutely wreck you if you enter at the wrong time, at the wrong price, without the right framework. So let's talk about price targets and, more importantly, the technical triggers that should govern your entries. For Applied Digital, the fundamental fair value estimate based on that backlog comes in around $50.09. The bull case is straightforward. The $23 billion contracted backlog creates a concrete floor that the market has not yet fully priced in. On the technical side, look for entries near the $32.50 put support level. But understand, it needs to break and hold above $29.93, which is the 200-day moving average, before you have real confirmation that the downtrend is reversing. The 119,000 call options sitting open are driving speculative momentum, not fundamental conviction. Keep that in mind. For CoreWeave, the average analyst price target lands at $125.16, fueled by that 110% year-over-year revenue growth and its near-monopoly position in pure-play GPU cloud. But the entry trigger is patient and disciplined. Wait for a confirmed hold at the 50-day moving average of $90.92. If that support breaks, the valuation peak narrative will take over, and the stock is vulnerable to a significant drawdown. The high leverage makes this equity extremely sensitive to any shift in market sentiment. Resistance above sits at $112. For IREN, Bernstein's price target of $100 assumes a successful and complete pivot to artificial intelligence cloud hosting. The entry here is conditional. A staged entry only makes sense if Bitcoin can hold the $75,500 floor. If that floor breaks, IREN will be dragged down with it regardless of what its artificial intelligence business is doing. Bitcoin resistance sits at $80,000, and critically, with an implied volatility of 131%, you must use limit orders on every single trade. Do not use market orders in this environment. You will pay an enormous premium that dramatically shrinks your upside. For Nebius, the consensus price target lands at $154.75, anchored by that software layer differentiation and the heavy institutional accumulation. The 50-day moving average at $118.57 is your primary entry zone. Key resistance above sits at $168.71. And remember, the insider selling under 10b51 plans should not deter you if you have a long-term time horizon. Programmatic selling is not a panic signal. The institutional buying happening simultaneously is the louder message. Before I give you the final verdict, I need to stop and be very direct with you about something important. Everything you've heard in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am not your broker. I am not your accountant. Nothing in this video constitutes personalized investment advice, and nothing here should be treated as a recommendation to buy or sell any security. Investing in individual stocks, especially high-beta, pre-profitability technology stocks like the ones we discussed today, carries significant risk. You can lose money. You can lose all of your money. Please do your own research. Please consult with a qualified financial professional before making any investment decisions. Markets are unpredictable, and past performance is never a guarantee of future results. Now, the final verdict. And this is where discipline separates the survivors from the casualties in a sector this volatile. If you prioritize visibility and defensibility, your attention should be on Applied Digital and Nebius. Applied Digital gives you the most concrete, near-term revenue visibility through its contracted backlog. Nebius escapes the hardware commodity trap through its software layer and carries the strongest balance sheet in the group. These are your relatively safer bets inside a fundamentally high-risk sector. On the other hand, if you are considering CoreWeave or IREN, you must approach with extreme caution. CoreWeave's liquidity situation, combined with the scale of insider selling, creates a cocktail of risk that demands strict position sizing and even stricter stop losses. IREN's inability to decouple from Bitcoin means you are not buying a pure artificial intelligence story. You are buying a hybrid, and you need to price that in. The artificial intelligence infrastructure build-out is 100% real. The capital expenditure treadmill that comes with it is brutal, relentless, and unforgiving. The winners in this space will be the companies that can fund the build-out without drowning in it. Keep your stop losses tight around those 200-day moving averages. In a market with negative margins, extreme betas, and liquidity mismatches, your most valuable asset is not your greed. It is your discipline. Now I want to hear from you. Here is the question I want you to think hard about and drop in the comments below. Which of these 4 companies do you think is most likely to be acquired or taken private within the next 3 years, and why? I'm genuinely curious what you think. If you got value from this deep dive today, please hit the like button right now. It takes 2 seconds, and it tells the algorithm that this kind of serious, data-driven research belongs in front of more investors. If you are not subscribed yet, hit that subscribe button and the bell notification so you never miss a Smart Stock Sam breakdown. And if this video saved you time, saved you money, or just gave you a framework you didn't have before, consider supporting this channel directly by hitting the Super Thanks button below. Every single contribution goes right back into making these deep dives sharper, more data-rich, and more actionable for you. This is Smart Stock Sam. Stay curious, stay disciplined, and I'll see you in the next deep dive.